All right, well, I think we'll kick things off, everyone. So on behalf of the team here at ARL Lawyers and our partners at Homes.co.nz, we just want to thank you for joining us this evening. Now, we know it may have been difficult for many of you to abandon the 6 p.m. news this evening, so we do thank you for joining us. With a bit of luck, we'll be out of here before the weather segment comes on, although looking outside, I suspect that the weather will be more of the same. For those of you who weren't as easily persuaded to join us this evening, we are recording the webinar and we do hope to provide it to you at a later date. By way of introduction, my name is Scott Ballack and I'm a law clerk here at ARL Lawyers, and I work in the dispute resolution and employment team. This evening, I have the pleasure of being joined by Ian Avison, Paul Logan and Brendan May. Ian is a partner of ARL Lawyers. He specialises in the sale and purchase of properties and businesses, estate planning, subdivisions, and a variety of commercial work. Paul Logan is also a partner of ARL Lawyers and specialises in the sale and purchase of businesses, property transactions, commercial work, and trusts and estates. Brendan is our in-house mortgage broker. He has considerable expertise in the banking and insurance industry. He's also a registered financial advisor. If you're considering buying your first home or you're considering refinancing your existing home, don't hesitate to contact Brendan, as he has a wealth of knowledge and would be more than happy to help you and your family. I now draw to your attention that today you should have received a handout in your inboxes, which has a little bit of information that will be handy at the later part of this seminar. If you're not sure if you've received it, perhaps now would be a great opportunity to quickly have a look in your inbox, as it may have swept away into the junk mail. In terms of a roadmap for this evening, we'll start off with a short presentation from Ian, Paul and Brendan. During that time, if you have any questions, at the bottom of your screens, there's a small Q&A function. If you'd like to press that button, it will allow you to ask any questions. At the conclusion of the presentation, we'll put those questions to our panelists where they can help you. So grab a tea, coffee, or perhaps something even a little stronger, and I'll now hand over to the panelists this evening.
Thank you, Scott, for the introduction. Scott described himself as a law clerk, but he is still for the moment, but as at last Friday, he got admitted to the bar as a barrister and solicitor at the High Court of New Zealand. So congratulations, Scotty. It's been a journey. For a young person or couple to purchase their first home, they'll usually require a deposit of 20% of the purchase price. There are some exceptions to this, and you can find those exceptions on our ARL Mortgages website. You will have heard the government talk about loan to value ratios and reducing the requirement for a 20% deposit down to a 10% deposit or even less. The reality is that the banks are not that keen on that idea, although it can technically happen. There is also a real cost to not having the full 20% deposit. And I'm just going to pause a little bit here and let Brendan, our finance and mortgage broker, jump in and explain how those, if you don't have the full 20%, how that extra charges that the banks will charge by way of interest or application fees will actually increase the cost of borrowing. So over to you, Brendan, if you could just run through those figures.
Yeah, thanks, Ian. Hey, thanks everyone for making it tonight. Appreciate your time. Yeah, so I've been in the industry for 14 years now. In terms of what sort of Ian suggested, obviously we can get home loans for our customers with a 10% deposit, but obviously that comes at a cost. And obviously the way around those costs are to either provide a gift or a guarantor for a loan. So what that means, if you've got the handout that Scotty spoke about on the second page, I've sort of put a little scenario together around what the extra cost might be for your children. We've just taken a quick scenario of a loan at sort of 87%, borrowing sort of $435,000. You'll see down a little box down the bottom, we've got some interest rates that are applicable for a less than 20% deposit. which on a standard rate of a 2-year rate today at 3.25. We're going to add a margin, which we call a low equity margin of 0.75%. And then on the other diagram, we've got it on a 20% interest rate, which is currently at 2.75. And what we've roughly worked out over the first 2 years of your children having a low equity fee margin loaded, it's going to cost them an additional $10,783 for that 2 years. And that doesn't stop there. What I've worked out is that it's going to take your children around 5.5 years to get to that 80% level where the margin will actually go away. Now, obviously, that margin will reduce over time. But I'm suspecting for your children at that sort of level, are probably going to pay an extra $15,000 to $20,000 over the first 5 years of a home loan. And if you come on as a guarantor or provide that gift, that's certainly going to save them money, of which they can obviously put in the bank. They could increase their payments to reduce their debt quicker. So you can see it's actually a cost-effective way for your children to get into the market and potentially save some money. So there you go, Ian. That's pretty much where that is. Now, obviously, if you want to talk to us about that, the scenario is not the same for everybody. So, contact us and we can work the numbers. We've got a pretty fantastic CRM which allows us to crunch these numbers for you and show you exactly how you and your children can move forward by helping them into their home. Thanks, Ian.
Thanks, Brendan. So the short answer there is just looking at that diagram, it would look like if your children or whoever you are trying to assist can come up with a full 20% deposit compared with having, say, a 13% deposit on those figures there, assuming a purchase price of a house of $500,000, it's about $11,000 saved in the first year. So that's quite significant. So that's a little bit separate from what we're going to talk about tonight, but by helping out and taking a bit of a risk perhaps for your children, there's actually significant dollars to be saved. So in simple terms, if a young couple want to purchase a home at $500,000, they'll have to come up with a deposit of $100,000. Now that's a heck of a lot of money to save in anybody's book. First homeowners, and also there's a few exceptions, you don't necessarily have to be a first homeowner, but generally first homeowners are able to draw their KiwiSaver funds out and use those funds to put towards the deposit. And that's what we find the majority of young people are doing. KiwiSaver has been a fantastic kickstart for people trying to get on the property ladder. So if a couple's looking to buy $500,000, a home for $500,000 and want to come up with $100,000, they might have $60,000 in their combined KiwiSaver. They might have a further $5,000 savings, but will still be short by $35,000. So how can this be made up? Well, this is where the bank of mum and dad come in. So imagine your daughters Emma and Matt as her partner. The bank of mum and dad could simply give the couple $35,000 jointly, no strings attached. Here's a gift, good luck, go and buy your home. Or they may choose to give their daughter, Emma, $35,000. Or alternatively, they could provide a guarantee for the $35,000 shortfall to Emma and Matt's bank. The bank would want some security for that guarantee, such as a mortgage over your own home, or a charge over a term deposit that you may have with that bank. It would have to be the same bank as your kids are borrowing through. Or you could loan the couple $35,000 interest-free. A number of the banks don't like the idea of your assistance being recorded as a loan, because that's obviously an obligation. But a number of banks are quite happy if the loan documentation says that everybody agrees no repayment is required until the house is sold. So at that point, great, $35,000 is there, the house is purchased, they've got the lower interest rate because they've had the 20% deposit. So going through the different options there, I'll speak about the first couple and Paul will finish off talking about the last couple of options there. But the simple gift, so that's everybody's happy, they want to buy a house, everyone's excited, and you say, here's $35,000 for your shortfall, away you go. This should be avoided if at all possible. Why? Because people separate. And if you've given the couple the $35,000 and they separate, you don't get the money back. You may not feel too good about this if the partner of your child has been abusive, unfaithful, or something untoward has gone on. But if that $35,000 was recorded as a loan instead, upon a separation, the bank would be repaid, the house is sold, the bank's repaid, and you, just like a bank, call up your loan. You say that that $35,000 was not a gift, it was a loan. Now, the difficulty there is with the best of intentions. In a separation situation, one party might say, no, that $35,000 was a very kind gift that you gave us. There's nothing in writing. Whereas you might be saying, and your child might be saying, oh, no, 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 that was always understood, that that would be a loan and it is required to be repaid back. Real simple solution, have it in writing. It doesn't have to be complex. We do these sorts of agreements all the time, and effectively it's almost like an IOU, saying that Matt and Emma acknowledge that they owe Ian and Sue $35,000. Simple as that. And that would mean in a separation situation, you've got that loan document that would go into the mix and you'd be repaid. And then at that point, you could choose, if you wanted to re-advance that $35,000 to your child to help them into another property. If you do wish to gift your child the $35,000, you could stipulate that you will only do that if the parties enter into a property relationship agreement, whereby they acknowledge that that gift of $35,000 is just for your child and is to remain as their separate property. These are sometimes referred to as prenup agreements. And what it would mean is that they would have a relationship property agreement that sets out what their joint property is and what their separate property is. And the gift to your child will be recorded as her separate property. If you choose to make a gift, you need to be absolutely sure you can afford it, because a gift is a gift. You can't ask for it back. And that may be difficult. As time goes on and you retire, you find that you want some money back, but your children aren't in a position to give you any of the money back. And of course, it's a gift in any event. The same really applies with a loan, which Paul will talk about. It can be a loan, but the chances of getting it back can sometimes be pretty minimal. If you also want to make a gift like that and you're concerned about qualifying as you get older for a rest home subsidy, MSD will count any gift you've made over $6,000 as still being an asset of yours, and they will treat that as your own asset when doing an asset test to see whether you are eligible. So that's another consideration that you would want to talk to us or your own lawyers about at that time. You also need to take into account, if you decide to make a gift to both of the couple or just your child, whether that is to be taken into account in your will, or if you have a trust, your memorandum of wishes. A lot of standard wills say dad gives everything to mum, mum gives everything to dad, and if you're both dead, then it's divided equally between the three kids. Well, when the divvy up comes, is the $35,000 gift to be taken into account and come off that child's particular share? Again, it needs to be in writing. So if that's in your will, you would just say divided equally between my three children, but take less $35,000 for Emma because she has already received that advance early. Another issue that you would want to take into account is whether you want to assist all of your children in the same manner and can you afford to do it. So if you're gifting one of your children $50,000 and you've got three other children, chances are they would expect that to receive the same gift, or even if it's a loan. If it's a loan, you probably should proceed on the basis that there's no guarantee you'll be repaid. So that's me as a part in respect of the gifting aspect and those options. Paul is now going to talk to you about the other options of loaning and guaranteeing. Keep those questions coming in and we will endeavour to answer them towards the end of this presentation. Over to you, Paul.
Yeah, thanks, Ian, and welcome everybody to the seminar. So I'm talking about loans and guarantees. So with the loan, to record the advance as a loan is probably a better alternative. As mentioned previously by Ian, you will have the ability to have the loan paid back in the event of a separation. And again, we just can't emphasise this enough, that it is vital that that loan be documented. If you record an interest rate in the loan, then that may trigger a tax liability for you. But most of the banks won't accept family loans as part of the deposit unless they are interest-free and the documentation states that no repayment is required until the property is sold. So sometimes that's a conflict on what you will require, but what the banks will accept. So that is an issue for you. So loans got to be in writing, got to be clear what the terms are. With a guarantee, that's another option. It can be a good option, particularly if the young couple have a good combined income but low equity. So that means, in simple terms, that you put your own house up as security for the shortfall in the equity to make your children's contribution the 20%, as Brendan talked about. So the bank that lends to the couple will want a mortgage over your home to back up that guarantee. So bear in mind, if the children stop paying, then the bank come knocking on your door for the money. And if the children's property is sold and there's a shortfall, well, then you're up for that, and you may have to sell your own home to service that guarantee. That's obviously a worst case scenario, but not an impossible one. Now, the banks always like to ask for what's called an all obligations guarantee, which means that whatever the couple have borrowed, you're going to guarantee. Now, we recommend you never give an all obligations guarantee to the bank. Any guarantee that you do give is limited to the shortfall amount, which was, as we talked about, that $35,000 in our example. So guarantee situation sounds pretty simple. However, the bank will actually require to do an assessment on you to make sure that you can meet the repayments should the young couple fail to do so. So that means that your own personal income and expenditure is taken into account. And the mortgage over your home will be a liability to you. So if you decide to use the equity in your own home to purchase a couple of rental properties, then the bank will take into account that you're potentially liable under the guarantee for the young couple's debt. So this may well affect your ability to borrow. And that's actually happened to a number of clients of ours and come to quite a shock to them. If you decide to sell your home, then the bank will either want a replacement security, a mortgage over your new home, or if you're trading down and hoping to raise a surplus for you to use in your retirement, then and you put that money in the bank, well, the bank will take a charge over the term deposit. Now, also you need to be aware that if your next move is into a retirement village, the retirement village setup don't allow mortgages to be registered over your occupation license in the apartment or villa that you're acquiring. You don't actually get a title when you move into a retirement village. You get an occupation license, and you can't mortgage those. So basically, you've got to come up with the cash. So at that point, if you sell your own home, you'll have to pay off the $35,000, which is the young couple's part of the guarantee, or again, provide some security to the bank by way of a term deposit. It's important to ensure that the guarantee is removed as soon as possible. In the $35,000 example, this could be achieved by the couple paying down the mortgage or having the property revalued to prove that to the bank that their equity is increased. Now, obviously, over the last 3, 4, 5 years, with the rapid increase in property values, that has not been hard to achieve. We're now in a post-COVID situation, and I think as a brave person to predict what the property market is going to look like in 6 or 9 months. So that rapid increase in property values to increase the young couple's equity in the property may not be as happen as quickly as it has done in the last few years. So if the property increases its value from 500 to 550, then the couple could go back to the bank via their broker or themselves and provide a valuation that shows they now have $150,000 equity, and at that point the bank could be requested to ask for your guarantee to be removed. So one thing is also important to note that the guarantee is in respect of all loans the young couple will have with the bank. So you want to have an arrangement with the bank and the couple that they will not obtain any further loans or debt without getting your written agreement. Otherwise, you could have a situation where their house is increased in value to 550, but they have decided without reference to you that they needed a new car and a European holiday and have increased their borrowings, which may be a little awkward around the table at Christmas time, but again, it does happen. And of course, the bank's always happy to lend on that because of your guarantee. So in that situation, if the borrowings are still greater than the 80% of the value of the house, the bank won't agree to release your guarantee. When obtaining further funding, some banks require the loan to be signed by the guarantors. And that's a good idea because it keeps you in the loop and you know what exactly the amount of the lending is. BNZ and ASB do that, but some other banks don't. So you might be sitting back and thinking, gosh, we'll be able to get that guarantee removed by now. The kids must have paid out a sizable chunk of the loan. The house has gone up in value. We'll slip down to the bank and request that guarantee to be removed. And you find that it hasn't. So that can be a problem. So what we're emphasizing tonight is that there's no crystal ball that we can predict the future of the children's scenario or yours. So if you're going to assist your children, which all of us want to do, in a way to get them onto the property ladder, you need to carefully consider, firstly, what the best way to do that is. Secondly, what would happen if the children's situation changes in the future, and what's going to happen if your situation changes in the future. Because you don't want a situation to arise where you have, by lending or gifting or guaranteeing, prejudice your own ability to enjoy a financially lucrative retirement because of the fact that too much of your money is tied up in children's advances or guarantees to enable them to get on the property ladder. And as Ian says, they may not be in a position when you need the money to be able to repay it. So the situation needs to be carefully considered to make sure that long term you're not going to be too affected. Once again, we'd emphasise that it's important, whether it's a loan or a gift or a guarantee, that your wills be updated to reflect the fact that there is that advance in some way to one of your children. And if you're going to do that, how do you preserve equity between, say, if you've got 3 children, particularly if house prices continue to increase. So child number 1 may need $35,000 to get them over the 80% threshold, but child number 2 may need $50,000 and child number 3 may need $75,000. So it's not an easy situation to try and maintain fairness and equity between the children, but you certainly want a situation where there's not going to be conflict in the family because 1 or 2 children feel they've been unfairly treated. So that's basically the run through of the various scenarios where you can assist your children, and you can see from Brendan's presentation that it does make a substantial difference if you can get them into the 80% or 20% deposit. And so it's certainly worthwhile doing, but there are a lot of factors that need to be taken into account, and it's not a decision you need to make lightly, and it's a decision that you should get some independent, proper advice about. So hopefully we've got some questions there, Scott, that we can run through, and so I hope that's been of value too, and thanks for coming along.
Yeah, thank you for that, Paul. Like I say, if you have any questions out there, feel free to submit them below. Any question I would be more than happy to answer. We've already had some questions come through, and I think I'll direct this one perhaps to you first, Ian. So we've got a question here which asks, why not own the house on the kids' behalf, get a lower deposit because of all of the equity and the other assets that you own, and therefore not incur the low equity margin costs that Brendan talked about earlier, and have the kids pay the mortgage and then gift them the house once they reach the 20% deposit threshold?
Yep, that could work if you have that ability and you do have, and you can meet the bank's requirement. What would be vitally important there is to have very clear documentation that you are effectively, and we do this quite regularly when people might have had difficulties in the past, such as bankruptcies or whatever, and they have difficulties getting a loan. You have people owning the property on their behalf. You can do that through a family trust or just a simple agreement. So it can work. And it may also provide protection in the event of a subsequent separation of the young couple. But it also does inhibit you in that, unless you're very wealthy, because that, as far as the bank would be concerned, that is effectively an obligation on you and a liability by you. Whether the young couple would feel that great about their home being owned essentially by somebody else, that would be something that you would have to work through. Again, clear documentation would be necessary there, and would also recommend that in that situation, the young couple would have their own independent legal advice as to the wisdom of entering into such an arrangement. So basically, you would have kids paying a mortgage that's in your name. And so if you go rogue on them, then they could be pretty upset about that and could lose. So again, vitally important to have very clear documentation. Scott?
Thanks for that, Ian. I've got another question here, which I think I'll direct to Paul. So we've got a question here. The child is currently engaged and she is buying a property in her name only. And the mortgage is also in her name only. Can her partner have a claim over the property? And secondly, what is the best way to assist the daughter, by gift or loan?
Yeah, thanks, Scott. So first of all, if the couple are living in the property and they've been together for 3 years or more, then there's a presumption that that property is the family home, and there's a 50-50 ownership, even though the property's in the daughter's sole name. So that's number one. Number two, I think there should definitely be a loan, as we've talked about, to make it clear. And number three, we'd strongly recommend that the daughter enters into a relationship property with her partner, which records the fact that the property is just the sole ownership is separate property to the daughter, and it's not relationship property. So the contract out of the Relationship Properties Act, that agreement could have a review clause in it, so that if the parties have been together for a number of years, then it could record the fact that the partner then starts to have some sort of benefit. But at day one, if the money's come from the parents, then a loan agreement and a relationship property agreement are our recommendations as the way to go.
Thanks for that one there, Paul. Now, I've actually got a question I think might be best directed to Brendan. So Brendan, this question's for you. does the bank have to know that you have loaned money to your child for the deposit, or can you just have a written agreement with your kid?
So the bank will require, so the bank has some certain documents that we need to provide them. So if it's a gift, we need a gifting letter confirming that it is a gift, it's not interest bearing or interest payable. And regarding a loan, if it is a loan, we need a loan agreement of sorts, and that would need to divulge the terms and conditions around repayment. And with regards to those repayments, if it's a monthly repayment, we need to put those into the serviceability calculators when we're assessing the home loan application, and the banks will form that as part of the debt servicing overall.
Thank you for that one there, Brendan. Now I've got another question which I might direct to Ian. This is, in terms of fairness between children, is the easiest way to employ the same ratio or percentage of lending to each child, or should it always be the same absolute amount?
Yeah, that's a good question. So you might have an age range with your children, perhaps of 10 years, and the 30-year-old, you might stump up with $35,000 for them, or provide assistance to that amount. And that for them might be the equivalent of 5% of a property. Then 10 years later, perhaps you've stopped working and your youngest says, can I have some assistance? Now, at that point, are you going to lend him or gift to him $35,000, or are you going to provide assistance to 5%? That is a tricky one. Obviously, with inflation and house prices, there's inequities there. That would just be a matter for you to work through. Personally, I would think that you would probably almost have to do it on a percentage basis, because those kids who've had the $35,000 first up 10 years before, their property will have grown significantly. So there's a lot to be taken into consideration when you're making these gifts. I mean, I guess possibly one way that you could do it at that time, if you're helping your 30-year-old out with $35,000, is that you could plop $35,000 into the 20-year-old's KiwiSaver and say, okay, that's your share at that time. But yeah, very, very good question, and it just gets down to the individual. Yeah, thanks, Scott.
No worries, and so now this one probably best directed at Paul. So the question we have here is, can you be a guarantor if you co-own your property with your partner? For example, be a guarantor using only half the value of your property.
The short answer is no. The bank will require, if they require a mortgage over the property, then both owners of the property will have to enter into that mortgage. So that if you want to use your property as security and there's two of you on the title, well then both of you have to agree to that. You can't just try and mortgage your own share, particularly if you own it jointly.
Thanks for that one there, Paul. Now,
I think, excuse me, Ian's got a comment on that.
Yeah, Paul, absolutely agree with what you say, but that's nothing to stop you having an agreement with your partner to say that if you jointly give a guarantee to support your child's mortgage and it all turns to custody, then that any loss pursuant to that guarantee will come from your half share of the house and won't be taken into account jointly. So if your house is worth $1 million and you have $500,000 equity in it each, and you want to support your children to $100,000, just the children of yourself, because perhaps you're in a second-time relationship, and then it all turns to custody for the kids and the bank comes knocking on your door for $100,000, you can have an agreement saying, okay, that comes out of my share of our $1 million home. My equity is now $400,000, yours is $500,000. Thanks, Scott.
Thanks, Ian. Now this one I'll put it into Paul. So who pays the lawyer fees and any loan to the kids?
Well, that's an agreement between the mum and dad and the kids, I suppose. Usually the kids should part because they're getting the benefit, but mum and dad will quite often part because every last dollar's sucked up by the purchase for the kids. The good thing is that if Brendan's doing the loan, he can usually get a generous handout from the banks towards legal fees, and quite often that'll cover the costs involved.
Thanks for that one there, Paul. And I've got one more question here. Look, folks, if you've got any more questions, feel free to get them in. But the final question here, Paul, is what is a property sharing agreement? And can you use that when you loan money to your children?
Well, a property sharing agreement is any agreement that deals with property. So you can have a whole variety of property sharing agreements. You can have one, as Ian just talked about, between a couple where the husband, for example, has decided to give a guarantee over his share in the equity of a property. So that's between the couple and say, well, he's up for the $100,000 guarantee he's giving. You can have a property sharing agreement between the mum and dad and the couple. You can have a property sharing agreement, which is a rent to buy situation, which Ian talked about before, where the mum and dad own the property and the kids live in it and pay the rent or pay the mortgage off and build up some equity. It's really an agreement between two parties that relates to a property. It's quite common to have a property sharing agreement, which we call a prenup between parties, like that scenario I talked about before, where the daughter buys the property with the aid of a loan from mum and dad, and then she's got an agreement with her partner that that property is separate property. Ian, you got a comment on that?
Yeah, no, actually comment about something completely separate. But I guess any of you folks who are watching who are over 35 will just be absolutely stunned at we can now borrow money at 2.65%. I had a deal in front of me today and sort of looking at this young couple telling them that this is amazing. They're sort of saying, yeah, thanks, Dad, carry on. But Brendan, I've been reading in the newspapers that, there's advertisements saying, why don't you buy a house? Because at 2.65%, it's probably going to be cheaper than renting. And if you do some figures, it could well be if you can get somebody in there. But I understand, Brendan, and if you could elaborate on this, that 2.65 sounds great, but the banks are actually assessing your ability to purchase and borrow as though interest rates may end up at about 6 or 7%. Is that correct?
Yeah, and so for the last 3 or 4 years, the banks have brought out a sensitivity rate, which has been used to determine the repayment of loans should rates go up in the future. Now that ranges between, don't quote me on this, indicatively between sort of 6.6 and 7.2%, depending on which lender we go to. And that hasn't changed, probably kept in place post-COVID for the reason that job uncertainty and bits and pieces. So yes, for a young guy last week who wanted to borrow some money, at 7% versus the 2.65, out of his income on the margin differential was about $27,000 of his income just gone in that margin serviceability. So that's making it hard still for first home buyers and young couples with not what I call average incomes to still get a home loan. I'm hoping that we do see that come down. I mean, I would have thought the banks might be around the 5% level, just based on the drop in the 2% that we've sort of seen over the last 12 months. But absolutely, it's still those high rates, and it's making it hard for anybody.
Yep, I understand. Brendan, that despite relaxing of loan to value ratios, that just over the last month or so, banks have tightened up a little bit, and it's a bit harder to get money than it was back in February. I have one example of a young lady buying her first home, and she had a couple of flatmates all lined up, and they were going to pay $150 a week each, so that's another $300. And when she first applied, but missed out on that house, that was taken into account. Now she's gone back to the same bank and said, I found another house, and they're saying to her, we're not going to count the the flatmate or boarder income anymore. Are you seeing that sort of thing?
Absolutely. So yes, the standard policy was 2 boarders per household for a home loan application. Now, whether the bank took that into consideration or not was at the discretion of the bank. All banks are different still at the moment, but the general policy is it's 1 boarder maximum, $150 per week, and that boarder has to have been living with you pre you buying a home to show that the income's actually coming into your bank account, because effectively it's just a piece of paper saying we'll pay it. Now, whether that's paid or not, the bank's got some certainty that that's actually coming in and it's going to be used as income.
Thank you.
No worries. Now we've got one last question here for the panel, and maybe I'll direct this one to you, Paul. Is it normal or okay to do a $30,000 gift from the parents and then also a further guarantee to get the kids up to 20%? Should it be one or the other?
Well, it can be both. They're not mutually exclusive. We're not sort of keen on gifts for all the reasons that Ian outlined in his part of the presentation. So if they're going to advance 30,000, then we would recommend it's a loan. But they could also, to get over if there's still a shortfall, to provide a limited guarantee over their property for the balance. Yeah, so it whatever works, but certainly, we never recommend a straight gift because of the ramifications that can have down the track.
Thanks for that one there, Paul. Now we've got another question sneaking in here. Why does the loan have to be interest-free?
I'll answer that question properly. So from the bank's point of view, as I said earlier, if it has a repayment structure to it, i.e. you've got to pay your mum and dad back $300 a week for that mortgage to get it, or that loan to get it from 35 down to 0, the bank wants to include that repayment and the serviceability of the overall debt and the repayments at their end. So again, if we're borrowing $435, got incomes of 100 grand, and we know what the expenses are on that mortgage, we know what their personal expenses are around rates, insurance, repairs and maintenance, all those sorts of things. And we've got the nice little $300 a week that they've still got to pay mum and dad because it's a compulsory payment. If that payment determines the serviceability of their loan being a decline, then it'll be declined on that basis. And it's just around income and expenses to make sure they can afford under the bank's criteria.
No worries. And maybe, Brendan, there's another question from the same person come in, but if it's not being repaid until the house is sold, does that affect that loan still?
No, so as Ian said before, as long as we get a letter from the parents advising it's a loan that's interest-free or repayable on the sale of a home, then that's not an issue. The bank effectively looks at it as a quasi-gift because it's not repayable until the end. But again, if there's a repayment structure in there for interest or principal, it needs to be taken into account when we apply for the home loan.
Thanks for that one there, Brendan. Now, at the start of the presentation, I did say that we might be able to get you folks finished before the weather, and I think that we might be running very close to that schedule. So on behalf of the team here at ARL Lawyers, ARL Mortgages, and our partners over at Homes.co.nz, we just want to say thank you for joining us this evening. Look, if anyone has any further questions that they need help with, if they're a little bit stuck on how to proceed in helping their children, feel free to get in contact with us and we would be more than happy to assist you with those questions. Also, if you have any questions about a mortgage for a new house or if you're considering refinancing, please do not hesitate to contact Brendan. He has a wealth of expertise, would be more than happy to help you out and help you get the most competitive interest rates. So on behalf of everyone, thank you very much. We hope you've enjoyed this evening and we wish you all the best. Thank you very much.